you. And hello, everybody, and thanks to all of you. As equally as importantly as Jackson, thank you all so much for being here. Means a lot to us, as always, to have you here with us to talk about the market and some changes that we've been seeing. Rest assured, there are changes. There have been some changes. Some may be leaning a little bit toward buyers, some maybe a little bit less toward sellers. The sky is not falling, but we do see some shifts happening. So we're going to try to catalog those and chat about those with you today. I'm going to throw some fish at you. I always like to say I'm going to throw some fish your way, but I also want to teach you how to fish a little bit, on your own, how to reel in a few charts on your own. And so time permitting, I hope to do that. So we're going to talk buyer activity, seller activity, home prices, market times. We'll talk a little bit about the shift that we see happening, a little bit about the economy and inflation, and a little bit on interest rates and affordability. So if that sounds okay with you guys, let's get cranking. All right, so first things first, some of you know I like to open on a note of levity, so a little bit of a laugh here to get going before we really go down our charting journey together. Okay, so got about a dozen individuals standing around a job site. Listing agent, kind of somewhat relaxed, but hopeful. I'd say interested. Seller, kind of up and engaged, kind of hands on hips. Neighbors, kind of curious. The lender, focused on the buyer, still focused on the buyer. Buyer's friend is still, on Zillow checking whatever. Appraiser and inspector are hanging out there. The lawyers, the buyers and sellers attorneys, well, they're laughing, right? They're kind of laughing at each other. And it's the buyer's agent who's just digging their way out of this thing and just making this happen, making sure this deal happens. And so I just thought this one was an interesting one. Hope you guys got a little bit of a kick out of that one. All right, so in addition to a little bit of a funny, I wanted to also do a historical one. So this one has a lot of different sort of listings, and you know what? Let me zoom in a bit. This one's just kind of exciting. So let's see, Minneapolis Journal from Sunday, April 25th of the good old year, 1937. First time offered, 47th and Fremont, $13,000, right? Sounds pretty enticing. Price of, what is that, $69.50, includes $1,000 worth of carpeting, drapes, and equipment. Okay, I like drapes and equipment. What else? Apartments for sale. What is that? 6,500, 3-apartment brick, 5% principal and interest reduced by each monthly payment. What about, wait a minute, there's this thing called a mortgage? Wait a minute. Convenient payments? I just pay my mortgage like rent, just like I would rent, and it just kind of takes care of itself. And wow, what a crazy thing, right? 3 fine bedrooms, oil heat in a basement garage. I think that means tuck under, right? About $7,500. $7,500. Nice St. Louis Park home for $4,200. $4,200 cash. You get the whole house, whole thing. I'm showing you this, you guys, to illustrate the point that prices change over time, don't they? Here's $3,450. There's your Longfellow. $350 down. $30 a month. $350 down. Prices change, you guys, and this was what, 80 years ago, 1940 to 2020. Yeah, 85 years ago. And in that time, 2 main things have happened: changes to the currency, right, to the real value of the currency, and changes to the market, to the actual value of the real property, the real improvements to the raw land that we see out in our community. So it's really those 2 things. Both are interesting, both have meaning, but sometimes we only want to talk about one. And so it makes sense to, take inflation out of the picture, or sometimes you want to just look at changes, in the dollar on the inflation side. So, as we hear about 9.1% inflation, which was what we saw in June, when you talk about 10% price growth, minus 9% to inflation equals 1% real growth. Or if you want to talk about 3%, a 3% wage increase, right, minus a 9% inflation rate equals a 6% real decrease in the wage. So just a way of, walking down memory lane and reflecting on the days of yore, but also just a way of understanding that prices change, and a dollar today simply doesn't buy us what a dollar did 85 years ago, much less 2 years ago. So yeah, I always thought that was an interesting one, just kind of looking at some of that historic data. All right, guys, let's throw a cheesy quote in there. We cannot control the wind, but we can adjust our sails. I actually spent a good few minutes looking up who said this, who spoke these words originally. I couldn't come to a compelling conclusion. So maybe Jimmy Dean, Bertha Calloway, Dolly Parton, Jackson Brown Jr., Ricky Skaggs, maybe, isn't he that bluegrass guy? Thomas Monson, or maybe is that Earl Scruggs? Maybe Earl Scruggs I'm thinking of. Anyway, so I like the quote, guys. We cannot control the winds, but we can sort of adjust our sails a little bit to capitalize on those winds and to make sure we're staying afloat in these changing times with these changing winds. So I think a lot of you know, but when written in the Chinese language, the word crisis is actually composed of two characters. One character represents danger and the other represents opportunity. It's actually JFK who said that, although I don't think he made up the term. I don't think he was that old near the end of his life then. So the word weiji, I think it's pronounced crisis, is comprised of these two characters, these two individual terms, danger and opportunity. And if you actually think about that, that's how you comprise, that's what makes up the word crisis. I think that's pretty interesting. So I've kind of, I've tweaked that a little bit, and I want to present my version. So, in times of crisis, there's danger and opportunity. Well, sure. But I like to say in times of change, there are threats, but there are also opportunities. And so all we can do is do our best to manage the downside risks while pursuing the best upside opportunities. So I've kind of tweaked that a little bit. I hope that's meaningful to you. What if I told you stats can be fun? In one hand, there's the red pill with no market stats. It's a sad, lonely life. On the other hand, it's the blue pill with market stats. The opportunity to be analytical, the opportunity to take emotion out of the process, the opportunity to say, here's what's happening with homes like yours in your market, in your price point, in this area. I choose a life of market stats. I encourage you to pursue a life, an enlightened life. Take the blue pill. Learn market stats. All right, guys. So I usually have a couple of these actually near the end of my slide deck. I wanted to throw a few of them at the beginning, and I think you guys will see why. So, again, I think most of you, well, I suppose I haven't even checked out the participant list, huh? Let's see. Ooh, definitely some new names here. Okay, so maybe some of you have not seen this. This one, guys, so this just tells the story. Just simply monthly PITI payments on the median priced home. So principal, interest, taxes, and insurance. Yes, we have to use some assumptions there, but that's your all-in monthly payment on that median priced home. And so that's kind of the technical, but I've sort of had a little header here. Historically low rates and rising incomes have partly offset price gains, at least until last year they did. So take a look at this. So 16 and a quarter. So it's about $16.25 per month. That's your all-in monthly payment. Yes, assuming 10% down and, assuming a couple other things, we have to. 20% down, a little bit less, 3% down, your payment will be a little bit more. But look at how flat it's actually been. So 1622, and actually into 2020, it held on really well. Even heading into 21, we're about 1760. So let's make the math easy on ourselves, guys. 1620 versus 1760. What is that? 80 and 60 is at 140. Did I do that right? About 140 bucks. Okay, so 150 bucks a month. It's not a huge difference. By the way, payments are only a little higher, but remember, prices are a lot higher. And that's the difference, you guys. Even though prices are all the way up here, payments were actually flat. And that's because rates had offset the impact of rising prices to keep payments flat. Falling rates offsetting the impact of rising prices, which ended up keeping payments flat. So that's what we've seen happening really over the last several years. this year has really been the exception. It's really been, once we started to see, 3-4 decade high inflation, once we started to see the Fed firing some of its bullets, in its target, overnight benchmark rate, its federal funds rate, that's when we really started to see some changes on the payment side. I think I saw my friend and past president, Todd Walker, it looks like Todd's still on. I think it was maybe 11 years ago, maybe 11 or 12 years ago, when I think Todd was actually the first person to say this to me. Todd, you said, David, this is a monthly payment business. That's what you said. He said, this is a monthly payment business. And I've used the term, he and I talk a lot, and he and I have talked, during his presidency. We wanted to use the right language around our press releases and with the public and with, our industry partners. And, we would say, we would use the term seller selected pricing, or, price sensitive versus payment sensitive. Most people are payment sensitive, and that it's a monthly payment business. And so, 90% of us have a payment. Only 10% of us pay for a home in cash, meaning 10% of us are price sensitive. The other 90% of us are payment sensitive. Now, rates have nothing to do with prices. Well, yes and no. Rates have a much greater impact on payments than they do on prices. I don't really care what inflation's doing if I'm not borrowing money to buy a home. If I've got 400K burning a hole in my pocket and I'm buying a home in cash, I don't really care that I could have financed that deal at 3% a few years ago or 5.75% today. Doesn't really matter. I'm not financing the deal. So yes, rates impact prices. As we just saw, when rates have been historically low, we saw some of the historically strongest price growth, because it means more people can afford, more people can bid up the price. That's basically what we saw. So now we're definitely seeing that change. So look at what's happened with payments, you guys. I've already spent too long on this chart, but it's just such an interesting one. $2,200 per month, that's the median payment on the median home, using some of these assumptions. So, you guys can kind of see it has moved a fair amount from the 16 and 1700 where we were, those levels where we were only a year or two ago. So rising rates have made an impact on payments, unsurprisingly, and that is going to have an impact on people's bottom lines, on budgets, and in particular on this thing called discretionary spending, the stuff that we don't have to buy, but the stuff that it would be nice to buy. Think of it as the wants and not the needs. We need food, and most of us need gasoline. Those are consumables on a daily basis, food and gas, right? But, and rent or mortgage, right? Those are hopefully non-negotiables, as we say. But, are you going to update your iPhone every year instead of every other? Are you gonna get a new car every other year, every third? Or are you going to wait till every fourth or fifth year? Some of these decisions, these are the things that are going to be impacted. And by the way, consumer discretionary spending is about 65-66% of our economy. So it's huge. All right, let's keep trucking, you guys. I nerded out on that one for too long. I apologize. And what are we going to do? Let's nerd out on it for a little bit more, but a slightly different lens here, you guys. So this one was payments. So this was framed in dollars, right? Dollar amounts, monthly payments. This is framed in a percentage of pre-tax income. So this is a percentage of our pre-tax income spent on housing. You guys will see about 25% of pre-tax income went to housing at the peak of the bubble, 2006. Home prices went on sale, but our incomes were actually buoyant. They actually stayed afloat. So suddenly when prices went down, we were only spending 13% of our income on housing, right? And now lately with the changes that we've seen, believe it or not, we're back up to 25%. And by 0.2%, that is an all-time high on this chart since at least 2003. Also since at last 2003. So what we can say here is, given some of these assumptions, for a family earning the median income who's purchasing the median priced house, they are now spending a larger share of their pre-tax income toward housing than they have been for any year going back to at least 2003. I'm pretty confident saying at least since 2000, maybe even since the late 90s. But then again, we did have that kind of dot-com bubble, in 2000, 2001. So I guess it's possible. I don't think it's likely, but it's possible that we had some movement there. So, guys, 25%, yeah, it's not much above 24.8. But it is above. And so, it's a high watermark, and not necessarily for the greatest reasons. But it's important to practice. What do I call it? Is it intellectual honesty, or I call it research integrity. We don't get to put the rosy glasses on. We get to look at this and say this is a challenge for us, right? This is a challenge. There are other elements that I think people have blown up, and the media, or they say economists have predicted 17 of the last 3 recessions. I love that. I love that quote. I'll say it again. They say economists have predicted 17 of the last 3 recessions. Means we're a little hot to trot. We're a little eager to say, oh, this is the one. This is the recession, right? Even though you were wrong the last 16 times. Yeah, you said that. This time, we could already be in one. We may be one later this year. We could be halfway through one. We could not see one until next year. It remains to be seen. It's just untold. But plenty of concern out there, to be sure. But there are some elements of this, guys, where a rebalancing market is a healthy and necessary thing needed to sustain a marketplace. Absorption rates have only gone from what, 1.3 to 1.6 or 1.1 to 1.5 months. It's not a lot. It's nowhere near a balanced market, but it's not as much of a seller's market, and that's important. Signs of rebalancing, signs of, I don't even know if I should call it normalization, but signs of a rebalancing and of this adjustment period that we're in, that will have some pluses and minuses, across the board. All right, price reductions. What time? It is 2:26 by my watch, and we are on our 3rd or 4th slide. I worry about my ability to get through all of these today, you guys, so stick with me for some fun. Price reductions. How many of our sales required a price reduction? In 2008, it was 48%, 47.7% of our closings required a reduction, meaning they had a list price that was not their original list price. It was less than their original list price. So 45 to 50%, we were there for, 43 to 50%-ish. We were there for 4 years, right? Kind of right during the crash when things unraveled. More recently, so this is pretty interesting, a little bit of a head fake here heading into 2014, a little bit of a head fake into 2019. I think that's interesting because that was well pre-COVID. That was in the BC era before COVID. And then look at, remember guys, so this is June of 2020. So this is still, COVID arrived in March. So April was a lockdown. So kind of April, May, and, May was a pretty fateful month as well locally. And then, June of 2020 was pretty quickly after the shutdown. So not a surprise that we saw this increase in reductions then for eager, motivated sellers who really did need to get those listings sold. They had to make them a little bit more attractive to buyers. That's okay. That's how markets work, right? Incentives. People respond to these incentives. So moral of the story, and I got to work on being a little bit quicker here, a little bit more succinct. Brevity is a virtue, said my Baroque music teacher. No, a Baroque teacher would never say brevity is a virtue. So look, guys, 15% required a price reduction. That is up from 13.5% from June in 2021. But 15% is lower than any June of any year since 2003, with the exception of 2021. So yes, while price reductions are up, they are still at an absurdly low level, right? So yes, price reductions have risen, but they remain at historically low levels. All right, framed another way, percentage of sales with a price reduction. Instead of just looking at June of 22 compared to June of 18 compared to June of 12, now we're looking at, well, let's look at a whole year, guys, Jan, Feb, March, April, May, June. So what I've done is I've got all the Januaries kind of teased out in this dark charcoal color. And then I've got our Junes sort of denoted in our lighter blue color, just so you guys can kind of see. One of the things I find absolutely drop dead fascinating is the U shape, right? So a lot of price reductions in January and December, no surprise, but not a lot in the spring, summer months. But look at 2020, look at what happened when you see price reductions actually, increase into June and then start dropping, and they were dropping into October. Well, here's October, guys. Reductions are never dropping into October. They are always rising into October. Here we fell into October. Just an unbelievable year with unbelievable stats, and really goes to show why some of these year-over-year comparisons were so, shall we say, wonky, were so sort of unique. So there you have it, guys. You can kind of see how we're shaping up now. So there's our 8.3 versus, wait a second, guys. I made a mistakey poo. I did not update this. That is my mistake. Please forgive me, guys. So the right number is this 15%. It did not trickle through to my 11.2. My mistake, guys. Use this one. If you're going to use this with clients, we're going to get you guys the right slides. But if you're going to use this with clients, use the 15. Yeah, use the 15. Apologies for that. We're going to get that one fixed. So let's switch gears, guys. Let's go over to the market. So let's look at showing activity. We used to do this thing called the stats deck. We are strongly considering resurrecting it based on your feedback from members and volunteers like yourselves. So it was really designed to be something that helped us see what was happening in light of the shutdowns and lockdowns and, you know, stay-at-home orders and some of those emergency orders. But it has remained popular since. So we're really kind of thinking through ways to bring it back. So stay tuned for that. Look at showing activity, guys. 2022, black. First half of this year, well, up until maybe late April, first quarter or so of this year, really looking good, really pretty strong. As we started to see the impact of these rate hikes and of the high inflation readings we've seen on the CPI, that's when we started to see showing activity dwindle a little bit. And you guys can see, you know, we've got holidays, we've got the 4th of July, and Labor Day and Memorial Day and Thanksgiving and all the holidays. But you can see showing activity definitely declined as we started to see these rate changes really take hold. Was that the case across the board? Well, how about different price points? So this is the most recent week this year compared to that same week last year, same week the year prior. Ladies and gentlemen, I'm showing declines in showing activity. I'm showing declines in showing activity. That shows us that how it shows if you watch the shows that are showing, showings numbers are down, right? The number of showings are down across the board with one exception, 800,000 up to 1 million. That was our, and that actually saw a 50% plus increase in showings. So that's the number, guys, right? This was a big decline on a number basis, but let's look at the share. I always like to look at the share. So listings under 200K went from about 17% of showings to about, you know, a little under 16% of all showings. Showings on 800K up to 1 million went from 1.4 to 2.8. Those just about doubled in share, right? So even though the number was up 50%, it doubled in share. Why? Because the numbers of everything else were down. Right? So even though the count was up 50%, the share doubled from 1.4 to 2.8 because the number of everything else was down even more. So always a little interesting, little factoid there, a little interesting process note. So yeah, we do see the share increase across the board in the segments that lost the least. These segments lost the most, so they lost the greatest share, leaving a growing share. Even if you had a shrinking number of showings, you can have a rising share of the showing activity. I know that's a little wonky. Please just bear with me and understand that it is worth explaining to your sellers, you know, here's what's happened with the number, you know, here's what's happened with the share, here's why I think we should keep being patient, or here's why I think we should consider, you know, a price reduction or, you know, something. So be thinking about that. And with that, guys, let's pivot. That's a theme that's going to keep coming up. Let's pivot to some of our longer term charts. And, you know, we're halfway through the year, guys, more or less. And so I'm going to be benchmarking some of these monthly figures with year-to-date numbers, with sort of annualized or year-to-date figures. So June new listings down 6% to just under 8,000. Okay, nice to see we're above June of 2020. You guys can kind of see us, you know, flattening out a little bit, maybe rounding down just a hair. So, you know, up and then down. So maybe we'd be pretty flat without this kind of up and down cycle. So let's annualize that, you guys. Let's actually look at the year-to-date picture. So on a year-to-date basis in the year so far, we're only down about 3.5% after being up just under 3%. So forgive, I know my numbers are a little tight. So we went from about 38.25 to 39.33 down to about 38, right? So yeah, this is how we are on a year-to-date basis, guys. We need sellers to continue to participate. We still need to fuel this demand. let's see where rates stop and let's see where demand is, but the market's still undersupplied, and I suspect it's going to remain that way for some time. Pending, so pendings did have to come down 18%. After we had that nice spike. Actually, this isn't even nearly the nicest one. We had huge double-digit gains later in 2020 and early 21. So we did have to cough some of that back up, you guys. So much of activity from this June was pulled into June of any number of months last year or the year before. So don't forget, we're borrowing demand from the future, from today, from last month, and we sort of incentivized it into the past with low rates and the understanding that prices were lower back then. And so, again, guys, let's annualize this on a year-to-date basis. Okay, so signed contracts soared 11.5% by mid-year last year, and then we had to come back down, 12%. So 30,000 versus 29.6. I don't see a huge difference, compared to pre-pandemic, on the signed purchase agreement side, but let's see where the rest of this year, let's see where the rest of this year lands and kind of where we end up. But, looking at this down 12%, well, okay, that could be discouraging. But remember, we're comparing against a pretty high watermark, a pretty high level, just in terms of how hot things were last year. So this is so interesting. It was the second half of 2020 that was hot, but it was really the first half of 2021 that was hot. Things sort of started to cool, into fourth quarter, kind of third, into fourth quarter last year. And then really first quarter this year, we really noticed it. So this is fascinating because remember, first half of 2020 was COVID, right? Well, second quarter, at least in particular, but the second half of the year, that's when we started to see that run on housing. And it was the first half of 21 that we really saw that strength continue. So it's always interesting, guys. You have to look at, on a monthly basis, and year to date. They both can tell different stories. And so it's important to look at both. How about our ratio? The ratio of pending sales to new listings. There's still about 70 signed contracts for every 100 new listings, right? That's about as tight as the market has been, minus 91 and 80, ridiculous numbers, right? They were real. That's what happened. So, the tightness, the ratio isn't unraveling. How about on a year-to-date basis for June? Actually, on a year-to-date basis, still really strong, right? 78.1, 78.8. We're still above. We're a tighter ratio. Demand is tighter with supply than it has been, right? For any year to date period, minus the previous two, right? 78.1 is higher than every figure on this chart, minus the two preceding it. So this is year over year, guys. This is June of 22 versus June of 21. This is seller activity by price range. So change in new listings by price range. So overall, there's our down 7%. And don't mind this, guys. It was just run at a slightly different time. But I think the key here is look at the 35% gain in new listings for Mil Plus and look at what we see in our luxury ranges. We see declines in our affordable ranges. Pendings, similar story, run a little bit earlier. So 18% versus what, 17.8. So as we see status changes trickle in, we see people make those status changes. We don't see that filter into our data until after some of those late status changes trickle in. So we release data, to the media and, we publish reports on our website. But then for a few business days after, we always keep updating data and we always still see some changes. And so we always want to reflect that most recent data, even if it's different than the official numbers, it's more recent. So it's more real. It's just the data environment that we live and breathe in. It is unique, but it is what it is. So pendings, you guys, right? We see the demand growth still in luxury, still 3/4 of a mil up to a mil, right? There's your 17.5% increase in signed contracts. We still had a 2.25 gain from 0.5 mil up to 3/4, right? Still saw a 2% plus gain in signed contracts on those listings. Down 10% from 350 to 500. It's a change. It's not a big change. It's, I guess, the second lowest decline of the decliners. So, there's still a lot of activity in that segment, you guys. There's still a lot of activity. It's just that instead of 2,000, there's 1,800, right? So just keep that in mind. It does look like, larger declines in that 150 to about 200 range. and then million plus. Guys, these million plus buyers have been absolutely active over the last couple of years. So maybe no surprise to see them, to see some of the activity dwindling a little bit. I mentioned cash sales earlier. Cash sales are only about 10 to 12% of the overall market, but they're more like 20 to 25% of the million plus market. I find that fascinating. Maybe not surprising, but fascinating. So we'll put it into housing. What is it? It's going to be down 25% of the stock market. It's going to be down 9% if you keep it in cash, 20% if you put it in equities. You should have bought I bonds with it or something. No, maybe muni bonds. Those are coming back. Who knows? So, those guys were so active, but they're not as sensitive to rate changes if you're paying cash. Well, 25% of them. So not most, but more are, a relatively larger share are paying cash. But I still think a lot of that activity has already happened. So let's see what keeps happening with that one. I think we have to keep watching that. So June new listings, guys, just kind of taking that broader view. I know we've seen some of these, a couple takeaways here. So seller activity was down after increases last year, which tells us that well-priced listings that also show well and are staged well are likely to stand out a bit more. However, buyers shouldn't suddenly think they have 100 times more choices, because that's just not the case. So similar story with pendings, you guys, right? Signed contracts down slightly. Well, down 17, 18% after we borrowed some demand and pulled it into 20 and 21. Also, remember, inventory constraints and rates or pricing, are mostly to blame. And all those factors are definitely hampering affordability. Closing, similar story with pendings, but remember, pendings are always that leading indicator. It's why we always prefer to use pendings as that leading indicator. It's the thing that happens before the thing that happens before the thing. Before it closes, it has to be active. Before it closes, it has to go under contract. Before it goes under contract, it has to be active. Before it goes active, it has to be newly listed. Before it gets newly listed, there has to be a listing agreement and a showing, right? And all these things. There's a chronology. I like to say there's a chronology to the process, guys. CDOM, we haven't looked at this one yet. Cumulative days on market. Oh my God. Is the sky falling? Seems to be okay to me. Seems to still be floating up there from my census tract where I am here. But, we added a day. We added one whole day from 7 to 8 days. Hold the press. Homes took 14% longer to sell. Everything's crashing. Well, I mean, I think you're overselling it a little bit there. You're talking about a day. Yes. The typical home spent one more day or 14% more time on the market. What is also true is that homes are still selling in less than half the time they did in 2020 and less than half the time they did in 2019, pre-COVID, and in a fraction of the time, that they took to sell compared to sort of the Great Recession and the crash. But, yes, absolutely. There are going to be people that look at that one day and will use it as fodder to support their misguided theory that everything's crashing, right? That is ammunition they can load up if they want to. I think you're going to see that if you haven't already. I also think it's important to keep in mind the other things that I mentioned. Everything's relative, you guys. Was that Newton? Einstein? Newton. Einstein's theory of relativity. I think it was Einstein. Anyway. So everything's relative, guys. So you really do have to kind of compare that to the past. But sure, taken in isolation compared to the prior June, yes, it took homes longer to sell. And you know what? Buyers should rejoice. Buyers should be thrilled about that. And since 90% of sellers are also buyers, unless you're going into institutionalized care or unless you're going back into renting, which very few people do, sellers also need some time to pack up their personal items and their toiletries and undergarments. Sellers need a moment, right, guys? It's just become so fast paced that a normalization, kind of a cool down is okay. It's an okay thing. Oops, what do I say here? Yeah, record time up 1 day. Technically, yes, 14%. It's exactly what we said, you guys. I didn't mention this last point. This can help manage expectations, both from the buy and sell side. May of this year, 7 days, guys. 7 days, right? A week. Half the homes selling in a week. It's pretty crazy. All right, median sales price, 8.6%. We did hit 380 grand. That is an all-time record high for us. Although that was not the number one most important message that we got out. Although yes, it is a new record. But that price growth rate was 8.6% compared to about 15%. So 15 down to 8.5, not quite half. That would be 15 to 7.5%. But prices are growing at just about half the rate. I guess a little over half the pace they were in the year prior. That is a good thing. 15% is simply not sustainable long term. And so, I think we're going to be seeing some 5, 6, 7, 8% this year. I'd be happy with some 7s and 8s. I think if we see a lot more 10, 12, 14, I think that's going to be concerning. I don't think we have that fuel in our tank, given where rates are. I just don't think we have that in us. But I still think there's plenty of runway, ahead of us. And I get asked a lot, what's going to happen with home prices. I do not think they'll decline for the foreseeable future, but I do believe they will grow more slowly. I believe the rate of growth will moderate, already has, right? We're already seeing it. We're looking at it right here. Until we get to 4, 5, or 6 months of supply, you guys, it's pretty hard to see prices soften. It's not to say it can't happen. It's pretty hard to see. I'm not a betting guy at all. I've been to Vegas twice. Each time I think I brought $300 or $400, and when it was gone, and I was fine. I do have a $100 bet with a friend that prices will not fall down year over year this year. I don't place bets, but I placed that bet. So how do you like that? What do we say here, guys? So while prices are still rising, they are increasing at a decelerating rate. So here's the key, and we actually talked about this at the beginning. Rising prices haven't been felt as much in monthly payments because rates were so friendly. But now that now that rates have risen from 3.5 to 5.5, payments have risen by, what do we see? 17 to by almost 500 a month, 17 and change to 21. Yeah, for about $400 or $500 a month. While prices are likely to remain firm, anyone who thinks they're getting a steal should probably rethink. And anyone looking to lowball, should probably rethink a little bit as well. I think I've got a joke about that coming up, actually. Zillow said my house is worth 400K, 150 on a good day. No, it's not that bad. CMA, Country Music Awards. Yeah, right. Comparative market analysis, country music. All right, median sales price, 9%, guys. That was May. Oops. I forgot to update that one as well. Let's bring our June report in. All right. Check it out, guys. I want you guys to see this one, just to kind of see the comparison. So sales price, there's our June, there's our 8.6%, there's our 380, and you guys can see where we were, about a year ago. So 12% versus 8.6. You guys want to see a little bit of how the sausage is made in real time? Ask and ye shall receive. This is how the sausage is made in real time, my friends. Let's copy that. Let's minimize that. Let's take this, delete this, replace this. There, we got our June guy. How do you like that? Oh, did Jackson try to beat me to it? I think he tried to beat me to it there. Thanks, JP. He's always got my back. Okay, so there you go, guys. June. So there's your 380, up 8.5%. And just one last note to keep beating this very dead horse. Look at the change, guys. 12, 11, 10, 8, 9, 10, 8, 10, 9, 8. So we're not above double digits. And you guys also kind of got a little bit of a sneak peek here, going back to May of 21, where we had 16, 15s, right? 12s, This is healthy. This is what we need. We need to be settling into this 6 to 8, 5 to 7, some even say 4 to 6%, sort of year over year growth pattern. Forecasts. Why is the MBA such a perma bear? The Mortgage Bankers Association is a perma bear. A perma bear is someone who's just always down, always thinks markets will go down. They're just so bearish, versus a perma bull, someone who's always an eternal optimist. All right, so the average of all forecasts, 8.5%, guys. What are we at? 8.6%. What's the last 12 months? 9%. That's a pretty darn good estimate, if you ask me. I probably couldn't have done it better myself. But again, I just find it interesting, to look at Fannie and Freddie versus Zelman and the Mortgage Bankers Association. I don't know why those guys are so bearish. Maybe because they see people's credit and the underwriting stuff. I don't know. I'm sure it's not that bad, but they're a little bit more bearish than most. Year over year change, you guys, you can see price change decelerating while still positive. It has decelerated from these high levels that we've seen. Jackson sometimes gives me a hard time about, David, you show so much history. Do we really need all this history? In some ways, yes. In some ways, maybe not as much. But I do like to show, look at how prices were growing in the bubble, kind of at the end of the bubble, not even 10%. And then in the crash, prices shed, 25%. They went from 200 grand to 150 grand. Boom, there's 25% in a month. I like to show that sort of artificial stabilization in the tax credit period. I like to show when investors and flippers descended on the market and picked up, picked up and rehabbed a lot of these foreclosures and flipped them. I like to show the more mature recovery, and then I like to show the COVID impact. And I just think this chart does a great job of cataloging kind of all of those. So yes, I know we do not always have to take a stroll down memory lane back to 2003 or 4 every time we do some market analysis, but it is useful to sort of benchmark ourselves historically a little bit. Percentage of original list price received. Oh my goodness, I'm sensitive to time here, guys. This has flown by. I'm sorry. There's so much more to squeeze in. Percent of original list price received. Same story, guys. Days on market. Yes, homes are taking an extra day to sell, but they're still selling in record time. Sellers are still getting historically strong offers, 103.3, but yes, not quite 104.1. So on average, sellers are still getting over 100% of their list price, compared to, 91.4% of list price, 95.6%, even 99.2% back in 04, right? So, I mean, what a number to go from 99.6 to 104.1 from June of 20 into 21. And, we've remained strong, right? There's still this residual heat. Even though rates have changed, yes, even though it has impacted demand double digits, yes, sellers are still getting offers 3.3% higher than their list price on average. So they're getting 103.33% of their original list price. Some are getting 110, 120%. Others are getting 70, 80%. On average, about 103. Yeah, so yes, indicating things have cooled slightly, but definitely remain elevated. The competition for the best homes will continue. So again, folks who see this, who think they're going to, lowball and write offers at, at 90, 95% of list price, you're just not going to be successful, right? No one can stop you from doing it, but the agent that's been driving you to 20 different houses is probably not going to be thrilled, especially at $5 a gallon. Inventory. Oh my God, we saw an increase. Everything is changing. Kind of, sort of, perhaps. What do you guys notice about this increase though? Let me get my, let me zoom in a little bit. What do you guys notice? So this decrease was pretty extreme. And this increase, I notice, is kind of in between these two, telling us what? Were we not to be in a COVID year with kind of unique things happening, and if it were just a strong market like it was before, an undersupplied strong market with shrinking inventory, but not a pandemic market with, the changes in interest rates and everything else that we've seen, I think inventory would have shrank from, call it 10,300 to maybe 9,500, and then maybe to 9,000, something like that. I think we would have seen maybe from here to kind of here to kind of here, but instead we saw here up to here. Does that make sense? So if you're what am I doing? You have two ways to get from your starting point to your end point. Well, three ways. 1, 2, or 3, right? So I think, we kind of did this because we kind of stopped here before kind of heading back up a little bit. And that's why we saw that plus sign. And this now looks like an alien with glasses or something. And so, just know that if we were not to have some of these factors pushing us down, and we would have been a little bit more like that, we would have paused here. So, yes, do we have more supply than last year? Yes. Does that mean that, you suddenly have all these additional choices? Not really, right? Not really, but yes, you have more. There are more active listings at the end of June. There were more listings in active status as of the end of June of this year than there were at the end of June of last year. That doesn't necessarily mean for your price point or your area, et cetera, but that is a fact. So if that's a calming force or, an encouraging force for your clients, use it. But I always asterisk it and say, it's really a month-end snapshot, and it may have more to do with the fact that demand came down instead of supply rocketing. Does that make sense? So these homes weren't being absorbed off the market as much, so they stayed on by month end, but it's not that we saw this surge in listings or in seller activity. So just keep that in mind, guys. All right, month supply. So here's our 22% increase from 1.3 to 1.6 months. I thought I saw something come through chat. Oh, okay, that's just my people saying.
It's just me giving people links towards the end of the meeting. No worries, David.
Awesome, thank you, beautiful. Yep, newsletter release, all of our many good things. So 1.3 to 1.6 months, you guys, yes, that's 23% more month supply. That sounds like a big number. And it kind of is, but it's kind of not, right? You're only talking about a third of a month from 1.3 to 1.6. And forget a third of a month, you're only talking about barely 1.5 months of supply. And we're looking for 4, 5, or 6 months of supply. So again, clients who see this in the news, or, if you tell this without the right caveat or without the right kind of parentheses, they're going to look at this and suddenly feel really empowered. And maybe they should feel a little bit more empowered, but they should not feel like they have all the power, because they don't. In fact, they don't have all that much of the power still. And this really tells that story that, yes, slightly better, a slight improvement. But, it's not enough to really move the needle in a meaningful way for buyers, especially buyers who are on a budget, especially those who are sort of on the fringes, in the margins, who are, wondering if they can make these prices work. Guys, buyers markets, sellers markets, balanced markets. I won't spend a lot of time here just because we're running up on time. Sellers markets, you've got a lot of buyers, but not a lot of supply. Buyers markets, you've got a lot of supply, but not a lot of buyers. All we're looking for is a good, healthy relationship, a healthy balance between all of them. A few applications. How the heck do I use this stuff? And the whiffle. What's in it for the listener? What's in it for me? Always the most important question. So, guys, you guys get asked questions every day, in person, via text, over the phone, via random chat, and through other channels. Are we in a buyer's or a seller's market? Month supply of inventory can tell you that. How long will it take me to sell my house? Days on market for single family homes in Edina, in Roseville, in Shakopee, right? For single family existing homes in the 350 to 425 price range. Boom, we've got the data. We can tell you, your results may vary a little bit, but this is a pretty good kind of guidepost. Will I receive below my asking price? Will I receive my asking price? Should I expect to receive above my asking price? You're in luck, because we got a stat for that. What's happening with new construction? We've got that. What's happening with foreclosures? We've got that as well. So whether you're at a listing presentation, an open house, a showing, whether you're doing prospecting or lead gen marketing, it's me versus the market. In St. Louis Park, the median days on market is 22. My listings in St. Louis Park only spend six days on the market. I can prove to you that I'm going to sell your home faster than my competition. That's really it. I've got evidence. I come with the data. I bring the receipts, right? I bring the receipts. How about managing expectations by showing market realities? I know you saw that we went from 1.3 to 1.6 months of supply. And while that's true, we're unfortunately still in a really, a pretty robust seller's market. So that seller of that $400,000 home is very unlikely to accept your 250 offer. I apologize for that. You know, you got to help manage those expectations. You just do. So, you know, be thinking about some of that stuff, guys. And we've got a whole lot of extra stuff that we never have time to cover. Even if we had 6 hours straight, there would be a lot of stuff that we just wouldn't have time to cover. So please do check some of that out. I'm going to speed through just a few insights from the economy, guys. Job growth is still strong. Strong job growth is not consistent with, you know, an unraveling in the economy. It's possible we're in recession or are about to be in one. But man, job openings have not gotten that message. So job growth slows, but still remains strong. You're seeing a theme here, you guys. It's come down a little bit, but it still remains pretty elevated. Unemployment rate pretty much back down to historic lows after kind of an unbelievable increase. I think we did this one last time. Who's in the metro area with the lowest unemployment rate of any metro? You are. You're sitting in it. Well, at least I think you're all local. At least I think you're all sitting in the Twin Cities. So, guys, we've got the most competitive labor market of any metro, of any major metro in the country. All right, 2 more minutes, guys. Bear with me. National delinquency rates. So Black Knight has this average, this 2000 to 2005 average. I really like that they've posted that on there. And then we're looking at the sort of current delinquency rate, which has really come down. But look at the COVID signature, right? It came way up. We were concerned about this. It looks like it really has healed. It's gotten a lot better. They've been doing some loan modifications, people getting current, where people successfully, selling and getting out of their position there. Retail sales. What's been happening, guys? Well, we were on this trend, right? We were on this trend for a while, and suddenly retail sales skyrocketed. Suddenly we were all buying everything from Amazon and elsewhere and everywhere else, right? Producers really didn't have a chance to catch their production up to our demand. They just didn't, right? So of course there's too much money chasing too few goods. Retail sales still strong. We're spending money. Total non-farm employees, right? Over 150 million people employed, right? I know we're a country of 340 million people, but a lot are under 18 and a lot are elderly or, not in the workforce. Industrial production, still strong. Total public debt, let's just not look at that one, 30 trillion. Let's just forget that one. The UMich consumer sentiment, guys, this one is fairly concerning. I'm going to be pretty honest with you. Consumer sentiment is just about at the lowest level it's been since the Great Recession. And it's pretty closely tied with the 81 recession, the last time we saw inflation this high. So this one is a little bit concerning, although it hasn't stopped us from spending. It hasn't stopped employers from hiring. And it hasn't stopped, people, well, not as many people are buying homes. It has slowed people down, I guess, along with rates. But I think people would have thought this would have had a much more dramatic impact. National Federation of Independent Businesses, small business optimism, also fairly low. We're going to skip that one. Whose fault is all this, guys? Last admin, current admin? Do we blame Vladimir? Is this COVID? Is the Fed all to blame? Are consumers just buying too many things, right? Early on, it was toilet paper and masks and sanitizer, and now it's just about everything else, right? Or these supply chain constraints that we keep hearing about. So has inflation peaked? Last month came in at over 9%, but you'll notice that markets were up, and that's because investors and traders are seeing that commodity prices are falling. They're also seeing supply chain backlogs are clearing. The bond market has reduced inflation expectations. We are seeing decelerating wage growth, and we are seeing some inventory growth, not housing, but goods, commodities. And in the retail, Target has some growth in inventory, things like that. Last one, guys. Homeowner equity. Homeowners have been gaining a ton of equity. They're sitting pretty, guys. The consumers are sitting financially pretty. They're sitting on cash, right? They've had stimmy checks, right? The stimulus checks. Last administration and the current administration both printed and handed out money. This is not a political left versus right thing, I promise. Sometimes it is, and sometimes one side, has a little bit of high ground, but this, it's not. It's just we were in an unprecedented situation. And so we had to fire all of our ammunition, and that's what we did. And why would we save our ammunition when we were staring off a global pandemic and, quite possibly a depression? So homeowner equity, guys, people are sitting on more cash. We're not spending it. We're not traveling. We're not spending it as much. So, we're feeling financially pretty okay, believe it or not. And last one, I know we're at 304, last two, guys. So the great mean reversion. This one shows median sales price from 1960 through 2022, or sorry, through the end of 21. We've got this channel in the middle, and this channel is kind of where we would be were we to have steady Eddie 5.6% annual price growth. What do you guys notice about this, though? We're not in that channel. We were way ahead of that channel in the bubble of 06. We fell well below that channel after the crash into 2010 and 2011. And now we're kind of clawing our way right back, maybe hopefully into that channel, or maybe we flatten out slightly, or maybe we follow the lower bound of the channel. Hard to know. What this tells me is this was screaming that we were overvalued, right? We were ahead of our skis. We were getting just a little bit ahead of our skis because we were so far ahead of this channel. This is the healthy channel. I'm willing to tolerate a little bit of variation within the channel. But when we are that far above the channel and that much below the channel, the pendulum has overswung. The rubber band has been overstretched, and it has to kind of snap back to normal or back to equilibrium. And so that's kind of what we're seeing happening a little bit. We were way over, so we had to be way under. Now we're way under, so the pendulum kind of has to overswing and get us back to where we should be. Yes, well, I don't remember, but I remember the image I showed you guys where homes were, 8, 10, 12 grand. There they are, median of 15,000 in 1960. You guys can see, right? Even back then we were below that channel, and then we were above. So, that channel, we don't always stay in it, but that's kind of that average. That's that average channel of kind of where we should be. I just have a couple more, guys. I won't get to them. We already talked about inventory being up a little bit, but what's driving inventory up? Look, new listings down 6%. Okay, well, that's not much, but pendings were down 17, 18%. So it's really about pendings being down more than listings, instead of being about listings suddenly surging. So I hope that makes sense, guys. I hope that makes sense. I know that's a little wonky, and we did see inventory from year ago and current year. We did see that switch take place, early May. So we did see that switch kind of take place. So just know that's a thing. You guys, you're encouraged to share this with buyers and sellers. Just make sure you kind of explain, what's happening with it and kind of what you mean by it. Okay, I guess I had more than I thought left over, and we will call it at that and save some for next time, my friends. I'm going to stop in the name of love, as we say. I want to say thank you again for hanging out with me today and going a few minutes over. Apologies again, we were a bit delayed getting started. Please join us next month as well. Looking forward to having you back. There will be more data to discuss. It's just always interesting, you guys. Every month it can change. It can surprise us to the upside. It can surprise us to the downside. So would really, really just be honored to have you guys come back and nerd out with us a little bit. And with that, I want to say thank you again so much. So grateful. And we look forward to seeing you guys next time.